If your spouse doesn't work, you're probably leaving $7,000 to $23,000 of tax-free retirement savings on the table every single year, and the IRS literally allows it. I'm showing you the exact spousal IRA framework that high-income couples use to double their retirement contributions while staying completely compliant. This compounds into hundreds of thousands, sometimes millions, in additional wealth over 20, 30, or 40 years. Let's break it down. First, the basic rule most people get wrong. You cannot contribute to an IRA based on earned income you didn't actually earn. That part is correct. But, and this is the loophole, married couples filing jointly can use the higher earning spouse's income to fund both IRAs. So if you're making $200,000 and your spouse is home raising kids, doing volunteer work, or running a side business that doesn't produce income, you can contribute $7,000 or $8,000 if over 50 to your IRA and $7,000 to their IRA, all based on your income. That's $14,000 per year in contributions. $15,000 if you're both over 50. Over 30 years, at 7% average annual returns, that's an extra $1.2 million in tax-deferred growth. We're not talking about some gray area hack. The IRS literally has a publication 7.1 of IRS Publication 590A that explicitly permits this. Here's where it gets interesting for business owners and self-employed people. A non-working spouse can actually earn income through the business without it affecting household finances. I'm talking about legitimate compensation for legitimate work. Example, you're running an S-Corp or LLC. Your spouse does actual work, social media management, bookkeeping, customer service, anything documented and reasonable. You pay them W-2 wages if S-Corp or Schedule C income if sole proprietorship. That becomes earned income, which qualifies them for their own SEP IRA contribution, potentially $66,000 or more annually, depending on structure. Now you've got two different contribution buckets. Spousal IRA contributions, passive, based on your income, $7,000. Their own earned income IRA or solo 401k, $23,000 to $66,000. That's not doubling retirement savings, that's tripling it for strategic families. The IRS audits this constantly, but the compensation must be reasonable for the work performed and documented. W-2s, contracts, time tracking, it has to be defensible. Now let's talk about the Roth angle, because this is where the real dynasty wealth building happens. Spousal IRAs can be Roth IRAs. Your non-working spouse makes a Roth contribution based on your earned income, and that grows completely tax-free. No required minimum distributions, RMDs, tax-free withdrawals in retirement, and critically, the money passes to heirs tax-free. If you're 35 years old with a 33-year-old spouse, and you each contribute $8,000 annually to Roth IRAs for the next 30 years, that's $480,000 in contributions. At 7% returns, that balloons to roughly $1.4 million, all tax-free, all inheritable tax-free. For people building genuine wealth, this is the foundation of tax-free income in retirement, and it integrates seamlessly with other strategies we cover here. Backdoor Roths for high earners, 401k coordination, HSA stacking. Let's address the backdoor Roth for couples, because most people miss the married filing jointly advantage. If your income phases out of direct Roth contributions, over $230,000 for MFJ currently, you can't directly contribute. But you can do a backdoor Roth, contribute to a traditional IRA, and immediately convert to Roth. For couples, both spouses can backdoor Roth in the same year. You're not limited. If you're both high earners or one spouse has significant self-employment income, you can each execute a $7,000 backdoor Roth. That's $14,000 annual tax-free conversions, repeated indefinitely. The pro move. Do this before the spousal IRA contribution if your spouse is non-working. Sequence matters for pro rata rules. Here's the practical checklist every married couple should execute. Step 1. Confirm your spouse is filing taxes, even if zero income. They need a Social Security number and a tax return on file. This is the documentation the IRS wants. Step 2. Determine if your spouse has earned income. If they work in your business or have any W-2 1099 income, Calculate the maximum they can contribute based on actual earned income plus spousal contributions. Step 3. Decide Roth versus traditional based on your tax bracket. If you're high income now, Roth is usually superior for spousal accounts because the tax deferral benefit is weaker than the tax-free growth benefit. Step 4. Set up separate IRAs in your spouse's name. Don't commingle accounts. The IRS and custodians track this by SSN. Step 5. Execute contributions before April 15th of the following year, or Dec 31st of the contribution year if you file early. This is a hard deadline. Now the integration question. How does this work with your 401k? If you have a solo 401k or SEP IRA from self-employment, spousal IRA contributions are separate. They don't reduce your 401k contribution limits. A solo 401k allows up to $69,000 2024 in combined contributions. That's maximized by you. Meanwhile, your spouse's spousal IRA gets another $7,000, $8,000. If your spouse genuinely works in your business and earns W-2 wages, they can have their own solo 401k too, compounding the effect further. The wealthiest families optimize all three layers. 1. Primary earner solo 401k, $69,000 2. Spouse's solo 401k if earned income. 3. Spousal IRA contributions, $7,000 to $8,000 each. That's potentially $152,000 plus in annual tax-deferred savings for one couple. Let's address the common mistakes. Mistake number 1, not filing a tax return for the non-working spouse. The IRS wants a paper trail. File a return even if there's no tax owed. Mistake number 2, using business income incorrectly. If your spouse doesn't actually work, don't pay them. The IRS will disallow the deduction and impose penalties. Mistake number 3, commingling spousal accounts. Keep them separate by name and SSN. Mistake number 4, missing the deadline. IRAs close on April 15th. 401ks close on Dec 31st. Don't miss it. Mistake number 5, ignoring pro rata rules on backdoor Roths. If you have pre-tax IRA balances, backdoor conversions get complicated. Consult a CPA if you have SEP IRAs or old 401ks rolled to IRAs. Here's the broader wealth-building context. Retirement accounts aren't just for retirement. They're tax-free compounding machines. Over 30 to 40 years, properly structured IRAs and 401ks become the largest assets in a high-income family's net worth. A couple saving $150,000 annually in tax-advantaged accounts combined that grows at 7% for 30 years compounds to roughly $15 to $16 million. The first $150,000 comes from contributions, the rest is tax-free growth. That's a completely legal wealth transfer mechanism. The IRS has literally designed it this way. Spousal IRAs are the overlooked piece that most couples leave on the table. Adding them to an already maxed out 401k strategy multiplies the final outcome substantially. Your spouse doesn't need to earn money to contribute to retirement accounts. You both can maximize accounts based on your household income. Combined with business owner strategies, backdoor Roths, and proper sequencing, this becomes a cornerstone of tax-efficient wealth building. If you're not executing spousal IRA contributions, you're leaving 6 or 7 figures on the table over your lifetime. Execute this year. If you want a step-by-step implementation checklist for your